Hi, this is Pete Birchler of StockMarketAlchemy.com. Tonight is Thursday, December 12th, an evening after the U.S. markets closed. This is going to be just a brief update showing the Bollinger Band setup here on the stock indexes and talking about a non-confirmation that is happening here between the different stock indexes. First off, what we're seeing here in the Dow, this is the Diamonds ETF, symbol DIA, is we've seen this Bollinger Band squeeze. So the stocks have been trading relatively tight for the last month or so here in a relatively tight range. And what we saw happen today was the bands expand and price close below the lower Bollinger Band. I've talked about this quite a number of times on the blog, but whenever we see a band squeeze followed by an expansion with a close outside the band, that gives us a volatile setup where we typically see some type of relatively sharp movement in stocks. This can be a breakout pattern for a new trend, or it can typically happen just prior to the end of a correction. And in that case, what we'll typically see is some further downside than a reversal in the market. And then a continuation of the trend. So those are two scenarios we should be looking at this time. As far as what may happen here, I think there is certainly a bearish case to be made, because if we look at the NASDAQ composite, it was able to push to higher highs for this rally on December the 9th. So that's where its rally peaked on Monday of this week. And if we look at all of the other indexes, if we look at the New York Stock Exchange, it peaked here on November 29th. If we look at the S&P 500, it peaked on November 29th. It almost reached a higher high on the 9th, but not quite. If we look at the Russell 2000, this is the IWM ETF for the Russell 2000. It peaked here on November 29th as well, and made a lower high on December 6th, and didn't even reach a higher high on December 9th. So the NASDAQ is the only index able to push to higher highs. All the other indexes did not. So these other indexes are not confirming the NASDAQ, which has been the leader of the rally here over the last couple years, really. So that does create a potential bearish overtone to the market climate here. As far as what we can expect to see based off of what is happening here, this pink box here in the Russell 2000 shows, if you go back to the November 2012 corrective low here, we've seen a relatively strong move up here in the Russell. We've seen a few minor corrections along the way, and these lines here on this chart and this pink box basically represents the 5 largest of those corrections during this uptrend, and so this box gives us the price and time minimums and maximums of those 5 corrections. And so if we were to see a continuation of this leg up here, we may expect this correction here to bottom somewhere in this range or very close to this range here. If we see price continue to move significantly through this lower price level here, around 106.5 on the Russell, or we see the correction get significantly longer in time, so into January or so, then we're going to have some indications that we're dealing with a larger correction in price and time, that the currents of the market may be shifting to the downside. And so we could be potentially seeing an even larger time frame correction occurring if we see that type of price action coming off of a high. Now, going back to the Dow for a minute, if we simply look at this move down off of the November 29th high, we're seeing a potential A, B, C type of pattern develop here. I've talked about this to some extent on the blog before, but the common support zone, if you look at this potential B area of an ABC pattern is between the 127.2 and 161.8 Fibonacci retracement levels, which would basically on the Dow put us at 157.12 down to around 156.20. So that would probably just be another day or so to the downside here before expecting a possible reversal to the upside if this is just going to be a brief correction in a continuing uptrend. And again, if we see the market below through those levels, that would be a sign that we probably are in store for at least a standard correction in the market, which historically an average or median correction in the market has been 10 to 11%, taking roughly 6 weeks. So if we were to draw that on a chart of the Dow, and we were to decline 10% from 161, we would be dropping 16 points, or a little bit more than 16 points, so we'd be down around 145. So that would put us all the way down somewhere in this region right here. And if we look at roughly 6 weeks time frame, that would put us somewhere in this time frame. So just again, if we are seeing an end to this move up in stocks here over the last several months, this would be the type of action we could expect to just see as a normal correction even in a bull market. And if we just project that down from some of the corrections we saw in over the last couple years, the September to November 2012 correction was nearly that large and took almost exactly that long in time. The correction we saw from May to June 2012, just a little bit smaller than that and not quite as long as that. So that's certainly a reasonable size correction we could see. So point being here is if we don't reverse off this lower Bollinger Band and off of this support zone here, we could have a significant amount further to fall, possibly coming down and clearing out all of these swing lows before the market potentially puts in a rebound attempt or a completed correction here. So that's something to look for coming up over the coming days and coming weeks. If there are any further questions about this market here, you can leave me a comment here on YouTube or over at stockmarketalchemy.blogspot.com. With that, I'll let you go for tonight. Have a great day and all the best to your trading.